Okay, guys, in chapter 4, you were to work on problem 4-4B, and this is on page 160 of your book. So we're looking at the adjusted trial balance for Anera Company as of December 31st. Anera invested $40,000 cash in the business during the year. The credit balance you see on this adjusted trial balance was the balance from December 31st, 2018. Well, I should say let me back up. Sorry about the confusion. Anera's capital on December 31st, 2018 was at $52,800. It's at $92,800 on the adjusted trial balance. So that means the change, the increase was from Anera investing more cash. So the first thing we do is pick up with that adjusted trial balance and grab your accounting cycle if you're like, what, where are we at? So remember, we take our transactions, create journal entries, post those to the accounts, create our unadjusted trial balance. Create adjusting journal entries for missing revenues and expenses, post those, create our adjusted trial balance. And it is this adjusted trial balance we use to create our financial statements. So they ask us to complete Anera's income statement. So remember, we're focusing on the revenues. And this company has quite a few revenues. So we're going to list all 4 of them on the income statement and then total them. Total revenues, $66,420. The expenses are then listed. Quite a few expenses as well, right? Depreciation, wages, interest, rent. I'm just skipping around here. Quite a few of them. And you can see they're in really no particular order, just as long as they're all there. Right? And we add them all up to get our total expenses. Subtract our expenses. I'm going to get rid of my ribbon here. So I have more room. There we go. Subtract our expenses from our revenues. It's a positive result. So net income, double underline. Income statement's an income statement. All your revenues minus all your expenses. Positive result, we have net income. So make sure you run through that again and you remember how to do that. The next financial statement is the statement of owner's equity. So I'm assuming that you have this done, so I'm going to move along a little. And we're just reviewing your work, right? Anera Company statement of owner's equity for the year ended December 31st, 2019. Now remember, it told us in the problem, Anera's capital as of December 31st of last year, when they finished out last year, was $52,800. During the year, Anera invested more money in $40,000, and the company during this year made $28,890 in net income. So we're going to add the investment and the net income to the capital balance as of December 31st, 2018. We then subtract the withdrawals that Anera took out of the business. So Anera's capital should be at $113,690. Now, according to our trial balance, the account balance is still at $92,800. But we'll come back to this and we'll show you that account will be updated. And that's what we report to decision makers. Now let's do our balance sheet. And we're going to do a classified balance sheet. And you see, it's in this report form, the one I was talking about at the end of our lecture. It is classified. No matter if you use account form or report form, your balance sheet is always classified. And the date is December 31st, 2019. So we're going to list each asset that will be used up, sold, or converted into cash first in our current asset section. Cash is always first. If you have short-term investments, they should be second. Then accounts receivables. This company doesn't have accounts receivables for whatever reason. So then we'll list the supplies and prepaid insurance. Supplies are always bought to be used up very quickly. If you have somebody buy a whole bunch of supplies and they sit in that closet for more than a year, you need to find someone new to buy supplies. Because supplies sitting in a closet is wasted money. Okay, we want our money working for us. Okay, so total current assets, in this case, $24,200. Now let's go to non-current assets. The only non-current assets this company has are plant assets. So we label, and then we list each one, remembering to subtract any accumulated depreciation related to it as we list it. So equipment we listed first. It doesn't matter which one's listed first either. Sometimes people put land, then buildings, then equipment. It doesn't matter. Equipment though, we list the balance of the equipment account, $24,000. We subtract the amount of accumulated depreciation. Remember what that is. That's the part of the equipment we've expensed so far. So it's the net of those two, or the book value, that's reported on the balance sheet for the equipment. Buildings, same deal. The cost or the debit balance of the building account is $100,000. The accumulated depreciation of building, the part of the building that's been expensed so far, $10,000. The difference between that is the book value of $90,000. And then land, we don't expense because it doesn't deteriorate, but it is a plant asset. So we add up the book value of the equipment, the buildings, and then the cost of the land. Our total plant assets are $140,500. Add the total current assets to the total plant assets. Total assets are $164,700. Now, instead of having liabilities and equity on the right side, we're going to have liabilities and equity underneath the assets. This is a report format. Looks like a report, right? So we're going to label liabilities and then list the current liabilities this company has, quite a few. And like I told you, if a liability is long-term, they'll tell us. So we assume basically most of our liabilities for purposes in our class are current. So we have here accounts payable, interest payable, rent payable, wages payable, property taxes payable, unearned fees. And there's that current portion of our long-term note payable. So that's the portion of the note that will be paid off in the coming year. The remaining part is in a long-term liability. We add up our current liabilities, $19,410, label them as such, total current liabilities. Label our long-term liabilities and our long-term notes payable with the dollar amount, $31,600. Add our current liability total to our long-term liabilities to get total liabilities of $51,010. So overall, we're still reporting our assets, we're still reporting our liabilities, we're just classifying them and coming up with totals in each category. Then report our capital, which we just calculated right up here. We're just gonna bring that down into our balance sheet. Total liabilities plus capital gives us total liabilities and equity, and that equals total assets. So we've just completed the financial statements and practiced the classified balance sheet for a NARA company. The next requirement is we need to close the year. So we need to reset those revenue, expense, income summary, and withdrawal account to zero. So we're going to take them one at a time. Now, what I suggest you do is create an account, even if it's a T account, for everything on this trial balance. So make a T account. On the debit side, $7,400. Make a T account for each asset with its balance on the correct side. Debits on the left, credits on the right. Make a T account for each liability with its balance from the adjusted trial balance. And the revenues, expenses, and sorry, I thought I saw something that was wrong, but it's not. Okay, so each one of those items on the adjusted trial balance has a T account or an account with the balance in it that's reflected on the adjusted trial balance. That's where that information came from. I'm asking you to create the item that helped create the adjusted trial balance. because it'll really help you see what's being achieved here, just like we had in our PowerPoint presentation. Now remember, during this process, first step, let's reset all of our revenue accounts. So once we post the journal entry, every revenue will have a zero balance. So if I look at my adjusted trial balance, and if you created those T accounts, your professional fees has a credit balance in it of $59,600. So the journal entry, you debit the account. Rent earned has a credit balance of $4,500. So in the journal entry, you want to debit it for that amount. Same with dividends earned and interest earned. These were all revenue accounts, earnings for different reasons, still revenues. We're going to add those up and credit the income summary account. So if you have your T accounts, post that. Post those debits to your revenue accounts and see now the account balance is zero. And then create, and I'm going to do it on my little piece of paper in front of me, income summary account. And on the credit side, $66,420. Remember, we just moved revenues out of the revenue accounts by debiting them and crediting the income summary. We moved revenue into this income summary account. We're going to do the same thing with each expense. These expenses, and if you made the T accounts for them, they all have debit balances. We need their balances to be zero. So we're going to have to credit each one for its current balance. You can see there, depreciation expense building, credit $2,000. The equipment, depreciation expense, credit $1,000. Wage expense, credit $18,500. So each expense individually must be credited for its current balance. Add up all those credits, and that's how much you debit the income summary account for. So at this point, post that journal entry and see now how when you credit the expense accounts, each one now has a zero balance. And then debit your income summary account, $37,530. So what you did there was take the balances out of the expense account by crediting it and move the total expenses into the income summary, $37,530. That's your second journal entry. So now if you posted these as you were doing them, your revenue accounts are zero, your expense accounts are zero. You're halfway there. Now at this point, find out what the balance is in that income summary account. Right here, you credited it for $66,420, and here you debited for $37,530. So a credit, a debit, take the difference. Its current balance is on the credit side, because that's the larger side, $28,990. Take a look. Net income. There's your income statement. So that should be the balance in that account. If you have net income, there should be a credit. And if there was a net loss, it should be a debit. Because what's in that T account? Your revenues and expenses for the year. So our next step is get that account to zero and get rid of it till next year. So debit the income summary for its current balance and credit capital. You essentially just moved net income into capital. And I'm going to put a little T account in front of me, call it capital. And on the credit side, I'm going to start with the $92,800 credit balance that's on my adjusted trial balance right in front of me. I'm now going to increase my capital, post that $28,890 to it. And I'm also going to debit the income summary account I have going for $28,890. I can see it's now zero income summary. My revenues are zero, my expenses are zero. And then the final closing journal entry, credit withdrawals for its balance, currently has a debit balance, we need it to be zero, so credit it, and debit capital, $8,000. And if you're doing this in the T accounts, revenue zero, expenses are zero, income summary zero. And now my capital increased $28,890 from my credit to it in journal entry 3. And there's a debit of $8,000, so it's going to decrease by $8,000. The new balance of my capital account is $113,690. Yep. And that's what we said it is. On December 31st, 2019, take a look at the statement of owner's equity. When we add net income and subtract withdrawals, the final balance in our capital account is $113,690. So if revenues, expenses, and withdrawals are zero, that capital balance better agree to your statement of owner's equity. Okay, so then if we were asked to do a post-closing trial balance, which this doesn't, but if we were, the only accounts we would see on it are the assets, liabilities, and the capital account with its new balance of $113,690. The only real purpose of doing a post-closing trial balance is for a manual accounting system to verify that debits equal credits in the general ledger before you start that next accounting year. Because if you start that next accounting year without those equaling, holy Hannah, you're going to have problems because you're not going to know why your debits don't equal credits. Okay, part 3 you're not responsible for. It's part of the problem, but there it is if you're interested in it, or if you have any questions on computing the ratio, I'd be glad to answer them. But you're responsible for that classified balance sheet and that last part of the accounting cycle in chapter 4. Closing journal entries, posting them to the T accounts, and creating that last trial balance of our accounting cycle, the post-closing trial balance. Okay, so that concludes our explanation of problem 4.4b. Please post any questions you may have to the discussion board. Thanks, guys.